Good day. This is the second part of the series on leveraging and capital structure of a business. And in this section, we're going to deal with the capital structure and specifically looking at the traditional approach of the capital structure. Remember, we said the capital structure is a mix of debt, preference shares, and equity, and that we want to achieve an optimal capital structure by lowering the cost of capital and therefore increasing the value of the company. So the decision of capital structure aims to maximize the value of the firm and to minimize the cost of capital, because if you can minimize the cost of capital, by implication you then adding value to the business and increasing the value of the business. Ford obviously wants to understand exactly where this point is, and they need to analyze this on a continuous basis. Remember, this optimal capital structure is not a static point. It is a flexible, fluctuating environment, and therefore needs to be adjusted and reviewed on a regular basis. What are the theories that we can analyze? The capital structure theories, there are what we call relevant theories and irrelevant theories, but we're going to focus on the relevant side. The important theories are the traditional approach. We're going to spend a little bit of time on the traditional approach in this section, and then in one of the next sections we're going to look at the M&M, the Miller and Modigliani approach, and also touch on the earnings per share and earnings before interest and tax approach. So the traditional approach is an approach somewhere between the net income approach and the net operating income approach, because they represent the extremes on either side. So the traditional approach is sort of an intermediate in between. So what is the principle behind this? The traditional approach says that the cost of capital, in other words the weighted average cost of capital, declines initially as we start using more and more debt in the business. At some point it bottoms out, and then it starts increasing because of the additional risk that is, especially financial risk, that is taken on in the business. And we'll see in the form of a graph exactly what that looks like. Okay, so the traditional approach in a little bit more detail. The value of the firm will increase initially because of the additional benefit of using debt, and then as the risk starts increasing, the additional benefit of the debt will be offset by additional financial risk, and eventually the additional financial risk will be more than the value that's contributed to by the reduced cost of debt, and that will then start increasing the cost of the capital and impact the value of the company negatively. On the graph, the bottom line, the cost of debt, and there you can see the cost of debt is fairly flat, and at some point it starts increasing because of we're running out of our optimal sources of funding, and the cost of the funding then starts increasing because of the financial, especially financial institutions and investors requiring a higher return as the risk of the business increases with a high exposure to debt. The top line is the required rate of return for equity, and as the risk gradually increases with more debt taken on, the required rate for the equity shareholders will increase because they want to be compensated for the additional financial risk that is taken. So looking at the KO, the weighted average cost of capital. So initially, on the left-hand side, starting at the 0 point, as we start using more and more debt, because the cost of debt is lower than the cost of equity, the weighted average cost of capital will therefore reduce as we increase the level or the portion of debt in the total capital structure, until we reach a point in the middle, more or less in the middle, where the additional risks that's incurred because of the additional debt in the business will then result in a higher required rate by the equity shareholders, and that will then flatten out the weighted average cost of capital, because the additional required rate by the equity shareholders will then offset the benefit of the additional debt, the additional cheaper debt. And at a later point, to the further right, the weighted average cost of capital will therefore increase, and it increases because now the additional financial risk that needs to be compensated to the equity shareholders is much more than what the debt and the cheaper debt could contribute. And as debt's price starts increasing as well, then we get to a point where it has a negative effect on the weighted average cost of capital. There's a much more detailed discussion. I'm not going to go into the detail here. It is exactly what we said so far. So there's a stage 1 where there is benefits in contributing additional debt into the capital structure. Stage 2 is when it flattens off and the weighted average cost of capital is at its minimum, and that's where the value of the company is at the maximum. And stage 3 is where the weighted average cost of capital starts increases, and because of the additional risk that is outnumbering the additional value of the cheaper debt, and therefore the value of the company will then start declining in stage 3. So what are the criticisms? There are 3 broad criticisms. The first one is the validity of the traditional view is questioned on the ground of the value of a company that's actually determined by the performance in its net operating income and any risks that's attached to that, and not necessarily only the weighted average cost of capital. It is also criticized that the total risk could be, let's call it, shifted around due to the different sources of funding that's being used. And the third one is Miller and Modigliani that criticized and said the return on equity or required rate on equity, which according to the traditional method stays unaffected by the leverage up to some reasonable limit, and they say there is not enough evidence to justify that this exists. So that brings us to the end of this session on the traditional approach, and in session 3 we will then specifically look at the Miller and Modigliani approach, and we will add some additional details on the Miller and Modigliani to try and explain that in much more detail.